Over the past couple of weeks, I've been getting asked the question of whether I am continuing to buy stocks while the market is continuing to hit new highs and there's arguably an AI bubble forming in the overall market, or if I am going to start cashing up right now. So in this video, I quickly want to answer this question because again, I'm being asked it quite a bit, and I do think that this is a question on a lot of people's minds right now. So I want to explain how I am investing in this market, what my mindset is towards buying stocks versus holding on to cash right now, and basically just what my overall strategy is. Now, I am also about to leave my city here in about an hour, so I didn't have a ton of time to put this video together. I have a couple of notes here on the screen, and I'm just going to basically walk you through my thoughts on the market right now. So I hope that this video does answer your questions and is still valuable to you. All right, so let's just get right into it. My answer is no. I am not cashing up in this market, and I am still a net buyer of stocks. I do believe that the S&P 500 is becoming more expensive, and that many of the largest stocks in the market are also expensive. I also do believe that we are in a little bit of an AI bubble. Now, I do know on this topic right here, I do know that Nvidia is growing incredibly well. It is the best reports I have ever seen come from a large business. The company is performing incredibly well. But what I am also noticing is every single business now wants to be an AI company, and everyone cares about, oh, well, how are you going to be implementing AI? And it seems like if businesses use the term AI in their own earnings calls or anything like that, then their stocks get a boost in the market. To me, this suggests that there is a lot of enthusiasm around AI right now. And that can mean that we are actually in a little bit of an AI bubble. I also recently saw a cannabis company pivot to become a data center company. And in my opinion, this is because there is a lot of hype and excitement around data centers, AI, and this overall AI revolution that we're calling it right now. But this one is tricky because NVIDIA's fundamentals are growing incredibly well. So I don't necessarily know if NVIDIA is a bubble, but I do think that there are other stocks in the market that are following NVIDIA with much worse fundamentals, seeing their stocks 10x. Those ones I am very cautious about. And that overall sentiment of fundamentally poor businesses seeing their stocks 10x within a month, that is kind of bubbly to me. And that does tell me that there is quite a bit of enthusiasm in the market. So yeah, it's something that I am watching. It's something I'm paying attention to. And that is something that I want to call out. So just be careful out there if you are investing in these AI businesses. Like, I prefer to invest in things that I can highly understand. And I simply don't understand NVIDIA's business. I don't understand why it has a moat. I don't know the tech of that business. It's way beyond me. So it's a stock that I've never really wanted to own. And personally, I do believe that it is expensive. Is it a bubble? I don't know, but it's not selling for margin of safety based on my own investment principles. So I'm missing out on this AI bubble, and that's completely okay with me. Now, additionally, people I know who have never invested in stocks before are buying Nvidia right now, and they also tell me that everyone at their work is too. So I went out for dinner a couple of days ago with a good friend, and he told me, well, he was asking me questions about what I think about Nvidia right now. And this person has never invested in the stock market. And the reason they asked me this question is because they told me everyone at their work is talking about Nvidia stock specifically. And everyone at their work is buying Nvidia stock. And no one at his workplace is an investor. It's just regular people now getting sucked into the stock market and buying Nvidia stock. Why? Because it has been going up significantly recently. And this is typically what happens when a certain stock or a certain sector sees a lot of momentum and a lot of growth in a really short period of time. It sucks in a lot of regular people who aren't really investors because they believe, or they're led to believe, that the stock can only go up. It doesn't matter how expensive the stock gets, it can only go up, and it's worth buying because it's a high quality business. I agree that Nvidia is a very high quality business, but price is very important. If you listen to the Lex Friedman podcast with Bill Ackman recently, he was stressing how important it is to pay attention to price with your own investments. And I have been burned by this myself. So I really focus on making sure my investments have a margin of safety and I'm not paying an exuberant price for the business. And when your everyday people who are not investors are being sucked into a stock because of enthusiasm, it tells me that that stock is probably quite expensive. And that is another sign that we could be entering a bubble. So that's just something I wanted to point out as well, and my thoughts towards the average person getting interested in Nvidia stock right now because it is happening. Now, the next point here is I do not pretend like I know what is going to happen to Nvidia or all the other A stocks like Super Microcomputer. This is not my game, and it doesn't impact me or my investing. So again, I do not understand this whole AI sector. I don't know what the moats are in the sector. I don't know if Nvidia is going to be the leader, or if in 5 years some other company that can make GPUs really well is going to overtake Nvidia, or if AMD is going to catch up and start overtaking Nvidia. Like, I have no idea what's going to happen 5 years out. I know that Nvidia is growing really quickly right now, but it's also worth noting that stocks top out when enthusiasm peaks. So it's when the business is performing its best that the stock tops, okay? That is very important to know. It is when everyone is so excited about the business and it's posting these absolutely ridiculous quarter after quarter after quarter, and everyone is so excited about it, that is when the stocks top. Now, I don't know if the enthusiasm has peaked because I don't know how to measure enthusiasm in the market. So I don't know when the peak is going to come to all of these AI stocks, but all I know is I'm missing out on it, and that's completely okay with me because it's not my game. I don't know how to measure enthusiasm. I don't know the moats in the industry. It's out of my circle of competence. So with this AI wave, if it is going to continue, then it's going to completely pass me by because I am not investing in it, and I'm not going to. I'm going to stick to my own investment principles, and I'm going to stick to what I feel very confident in and my long-term investment strategy that has been working incredibly well for me over the past about 3 years now. So this whole AI wave is not impacting me or my investing, and it is not going to lure me into it. I'm going to stay out of it because, again, it's out of my circle of competence, and that's just as simple as it gets. Now, moving on to the overall market, I do not view the market or even the S&P 500 as all stocks. And what I mean by this is that I look at each business individually and ask if its stock is cheap relative to the fundamentals of the business. So whether the S&P 500 is hitting all-time highs or not, I don't care if I believe that there is a business within the stock market that is cheap relative to its underlying fundamentals. And I do believe that some stocks in the market are still cheap right now, and I am continuing to buy them. They may fall if the S&P 500 sees weakness, but that will just mean that they're becoming cheaper for me. As a net buyer of stocks, I do not mind seeing stocks fall, as I can just continue to buy more. It's also worth noting that not all stocks move with the S&P 500, so I do believe that I can have my investments rise even if we do see some weakness in the S&P, or if the S&P does see some sort of correction. So again, I just do not think that the S&P 500 and its price action is going to reflect on every single stock in the market. So even if the S&P 500 falls or sees some sort of correction, I am still going to be buying stocks that I believe are undervalued right now, and I do believe that those stocks can continue compounding even if the S&P 500 sees weakness or does not do anything for a few years, because the fundamentals of the businesses that I own are going to continue growing, and I am getting them for a pretty cheap price on cost today. So that's really what I focus on. And then a perfect example of this is Berkshire stock, and it had gains while the tech bubble was popping. So did Royal Bank, and so did TD Bank. So these businesses and their stocks were seeing growth while the overall market and the S&P 500 were absolutely collapsing, and the tech bubble was bursting. So this is a clear and perfect example that just because the S&P 500 is falling does not mean that every stock cannot go up. There will be stocks that continue to go up, and there will be stocks that are cheap relative to their fundamentals, and as their fundamentals continue to grow, their stocks should continue to grow as well. So just because the S&P 500 is high, or just because Nvidia stock is hitting an all-time high and we're debatably in this AI bubble, it does not mean that I should not be investing in other businesses that I understand very well. They're within my circle of competence, and I think that they are cheap. They're completely different things in my own brain. And then right here, I do have some stocks that I do still think are cheap in the market today. Equitable Bank is one of them. This business is trading for a price to earnings ratio of about 8.5, which is about a 12% earnings yield on cost, and the business is projected to grow its earnings per share at 20% in 2024. So an 8.5 price to earnings ratio with 20 projected growth this year, that looks very, very cheap to me. And this is one of the stocks that I have continued to buy consistently, even though it is at all-time highs right now, and the market is hitting all-time highs. I don't care. I think this stock is still cheap. Then we also have BN and BAM. I recently made a video, well, I've made a few videos on these stocks. I genuinely believe that these stocks are also cheap in the market and selling below fair value. And these are stocks that I have continued to add to. They're the largest positions in my portfolio by far. And I'm going to continue to add to them so long as their share prices don't get up to ridiculous levels. BN, for example, is trading for 13 times cash flows and projected to grow its cash flows by 20% annually out to 2028. So 13 price to free cash flow, 20% growth. That to me still looks cheap in the market, and I am happy to continue buying it as long as I believe its fundamentals are strong and its stock is cheap. Then we also have Go Easy, which recently reported its earnings. It is projecting 20% growth in 2024 as well, and it's trading for a price to earnings ratio of 11. That to me also looks cheap. So I do still think that there are stocks in the market that are looking cheap, and these are the ones that I am going to simply focus on buying. Yes, these stocks could see some weakness again if the S&P 500 does see a correction, but that just means that their overall prices will get cheaper and my future returns will get higher. So as a net buyer of stocks, I just try to focus on increasing my ownership in high quality businesses and buying good businesses at below fair value. And I'm going to continue doing that no matter what the S&P 500 does. So then the question becomes, how do I handle missing out on all of these huge and quick gains? Well, the first thing that I would actually point out is that my portfolio is outperforming the S&P 500 so far year to date. Even to this day, my portfolio was actually up 1.2% on Friday, while the S&P 500 was basically flat. So in terms of missing the huge gains in the S&P 500, my portfolio is actually continuing to outperform. But in terms of the huge gains from Nvidia or Super Microcomputer or whatever that stock is called, I just don't really care because again, that is out of my circle of competence and it doesn't stick to my own investment principles. And if something is outside of my investment principles, then I simply ignore it. It is not something that I focus on and I have to be comfortable and okay with missing it. I don't let myself get beat up by it because I have an investment process and a framework that works consistently over time. If something is outside of my framework, then it is simply not for me, and I am okay to miss out on it. You do not need to be invested in everything or even to have an opinion on everything. Like that's what I'm trying to say here is since I don't know the moats within the AI industry, it's just not something I want to invest in. And yes, I could miss out on some huge gains there. That's fine. I will just not invest in something I don't understand and stretch my risk for more gains. There will always be a stock, sector, or other investor that is outperforming my portfolio, and I am okay with that. I am never going to own every single stock that is performing the best in the market all the time. It is it's basically a mathematical impossibility. So why even try? Why even try to focus on this? There's going to be stocks that are going to outperform my portfolio. That's just how it is, and it's always going to be that way. There's going to be sectors that run that I do not understand. That is fine by me. There are going to be other investors, especially in this current market, that are massively outperforming my portfolio, and that is okay. I do not have to go and chase their returns because I am not in competition with them. I am not competing against these other investors. I am competing against myself, trying to become the best investor that I can be. I am my competition. And additionally, I know my own goals. I know the return rate that I need to achieve to become extremely wealthy by my retirement. So moving on, if I were to chase every stock or every strategy that was currently outperforming, then I would be constantly changing my investing and chasing whatever is currently hot. And I do not think that this is a way to win in the markets. I think that you have to stick to an investment strategy for the long term and not just be jumping in and out of sectors, in and out of hot stocks, trying to time the top, trying to time the bottom, buying what everyone else is enthusiastic about. I do not think that that is a long-term winning strategy in the stock market. It can work for a short period of time, but over 30 years, I do not think that this is a way to win in the market. So the best strategy is the one that I can stick to for the long term through thick and thin. And this is an investment strategy, my current investment strategy, that I will stick to through thick and thin because it's based on logic and it's based on fundamentals and the value of businesses. So if things are going through a bad period, I can understand that I'm buying a fundamentally sound business for cheaper, which also should mean that I get higher returns on the future investment, or my future returns on that business should be higher as the price goes down. So my current investment strategy, since it is so based on logic and fundamentals and value, if I'm going through thick or thin, I'm going to stick to it because it just makes sense to me. It's not me gambling. It is something that I tangibly can understand. Then right here, I say that Buffett did not change his investment strategy in the tech bubble, despite other investors generating significantly higher returns during that period. He watched others make a lot more money, a significant amount more money, and he stuck to his investment principles regardless. He was not willing to change his own investment principles that he knows will work over the long term. He was not going to chase the short-term gains. And in the end, that was his best decision. And while tech stocks and the market was crashing after the tech bubble burst, Berkshire was rising and continued to compound wealth. And Warren Buffett has continued to compound his wealth long after the tech bubble has burst. So he doesn't focus on what's working in the short term or generating a significant amount of returns in the short term. He focuses on what is going to work over the long term. And sometimes that long term mindset isn't what is hot in the market, and things are going to outperform. Your investment strategy may underperform for a year or two, or maybe longer, but I have got to stick to what I know will work over the next 5, 10, 20, 30 plus years. I also understand, again, that I do not need insane returns to become wealthy. What I need is to avoid significant losses. And how I avoid significant losses in my portfolio is really understanding the moat of a business now and not going out of my circle of competence or chasing hot stocks or buying stocks that the market is very enthusiastic about and are incredibly expensive. I think that this is a way to lose a significant amount of money. Yes, again, it can work in the short term, but over the long term, I do not think that the strategy is a very good risk reward. And I actually do think that buying really expensive stocks is how you lose a significant amount of money. And that is something that I try to avoid like the plague in my portfolio, is losing a lot of money. If I can compound my wealth at 8% annually, then I will retire very rich. I hope to do much better than 8%, but it's all I need. This is something that I write about in my book, and I really stress that you only need an 8% return rate over the course of your life to become wealthy and retire a multi-millionaire. You do not need to chase 50% returns within a month. You do not need 20% annually. You should not even try to get 20% annually. Because to put it in perspective, Warren Buffett, who is the best investor who's ever lived, his long-term average investment return annually is 20%. And he's just been able to compound wealth at 20% for like 70 years now. His annual returns are not 50%. They're not 30%. They're 20%. And again, if I can compound my wealth at 8% annually, then I will retire very rich. I do not need to stretch my risk or chase these high returns to become wealthy. I stick to what I know and I continue buying stocks that I think are cheap. It is as simple as that. So yes, in this market, I am still a net buyer of stocks. I am not cashing up. I am not trying to time the market. I am not going to sell a business that I think is fundamentally sound like Equitable Bank and also cheap like Equitable Bank just because I think the S&P 500 is expensive or we are in an AI bubble. All I care about is that business cheap relative to its fundamentals today? And that's all I want. And if it is, then I buy it. Yes, the stock could go down with the S&P 500, but that's okay. Since I'm a net buyer and since I have cash coming in, that just means that I can continue to dollar cost average into that position and buy more if the stock is down and get higher future returns. So that is my perspective on the market right now. That is the investment strategy that I am using. It's very consistent with everything you have probably heard me say on my channel over the past couple of years now. This is the investment strategy that I have come to really respect, learn, and understand. It's also an investment strategy that I believe emulates Warren Buffett, Charlie Munger, Peter Lynch, and all of these other guys that focus on the fundamentals of a business and not try to guess what the stock prices of those businesses are going to do. All that matters is focusing on the business, focusing on its fundamentals, and trying to buy its stock at a price that is discounted to what you believe the value of the business is. And that is still happening in this market, and I do still believe that there is value out there. I also write about this in depth in my book and the mindset that investors should have towards volatility and euphoria in the market. So seriously, if you want to improve your investing, become a better investor, and learn more about this investment strategy, then go and consider picking up a copy of my book, The Fundamentals of Investing, on Amazon. It is a #1 bestseller. It's been getting a lot of 5-star reviews. So if you want, go and check it out on Amazon, read the reviews for yourself, then make a decision. I also have a video explaining all of the content within the book if you are interested in knowing what you're going to get when you buy it. But I truly believe that this book will help improve your own investing, especially in times like we are currently in. So I know that I wrote it. I know that I am plugging my own content, but I genuinely believe that this book will help you. So go and check it out. And I really hope that you guys enjoyed this video. And if you did enjoy the video, then also remember to leave a like on it. And if you're new here, then consider subscribing to my channel. But with that being said, that is going to wrap up the video for today, everyone. Thank you so much for watching. I truly do appreciate it. And I really hope to see you all again in my next one.